very good afternoon to all. So, I am Professor Anuradha Jain, Professor of Economics at Vivekananda Institute of Professional Studies. Today, we are going to discuss investment function. So, we will be deliberating upon what investment is, what are the determinants of investment, how we take investment decision and all. So, what is investment? Investment means spending money on acquiring physical assets, financial assets and human capital that yield a return over time. Acquiring physical assets takes the form of land, building, maybe machinery, equipment, financial assets like time deposits, shares, bonds, mutual funds, etc. Human capital formation is spending money on higher education or professional qualification or expertise in any field of knowledge. Even lending money on interest is a form of investment. Now, what are the different types of investment? There are different terms, related to investment. First is business fixed investment. Business fixed investment means when a business person of a country starts to invest money in the machines, tools and equipment to increase productivity or maybe to start any new business. And this kind of investment increases the value of the company and overall assets of the company. Second may be residential investment. All of you know that residential investment means the investment which people spend money on construction or buying new houses or for the purpose of staying or renting out to others. Then there can be inventory investment, like firms hold inventories of raw materials, semi-finished goods to be processed into final products. Inventory investment is a measurement of the change in inventory level in an economy from one time period to the next time period, and for the process of production to be held in a smoother way. Inventory investment is very much required, and every businessman keep inventory stock with them so that they can produce goods without any hurdles or without any obstacle. The next type of investment is induced investment. Induced investment refers to the investment which depends on the profit expectation and is directly influenced by the level of income. It is income elastic, that is, it increases with the increase in income and vice versa. As seen in the diagram, you can see that induced investment curve is sloping upward from left to right, indicating that income rises, investment also rises. And you can see this like on x-axis we are taking income, y-axis we are taking investment, and the graph is upward sloping, and you can say that as income increases, investment also increases. So, induced investment means when investment is dependent upon any other factor. Okay, so here investment is dependent upon the level of income. So, therefore, it is known as induced investment. Next is autonomous investment. Now, autonomous investment refers to the investment which is not affected by the change in the level of income, and it is not induced solely by profit motive, and it is income inelastic, that is, it is not influenced by the change in income. And you can see in the diagram that it is a parallel curve, parallel to the x-axis, it's a horizontal line, and which shows that there is no relationship with income and investment. It means that whatever is the level of income, that investment will be there, and therefore it is known as autonomous investment. Now, in fact, you know that income and interest rate are not the only determinants of investment. There are other factors also which are known as exogenous factors which affects the level of investment. Like, for example, it can be innovations in the production technique, it can be invention of new production process, or invention or discovery of new raw material. So, anything, if any change happens, and that lead to the change in the investment. So, not only just interest and income, but there are other factors also which affects the level of investment. Invention of new products is another factor which affects the level of investment, discovery of new markets, growth of population and its spending power. And now you can see the example, like because of the incoming of MNCs in Indian economy, you know that people have more income package, they have more purchasing power, so demand increases, and if there is more demand, then investment increases because businessmen find their business to be profitable. Then expansion plan of business firm, that will also lead to increase in investment, increase in public expenditure, future expectation, emergence of new entrepreneurs. So investment depends upon many factors other than interest and the level of income. Now, what are the main determinants of investment and on which mainly our investment depends? So it can be like revenue, expectation about the future income, cost, mainly the cost is the interest rate, and overall marginal efficiency of capital. So first, if we talk about revenue, then you know that major investment is done with the motive of maximization of profit. So if revenue increases and if businessmen see that their business is profitable, they are giving more revenue, so obviously investment will increase. So investment is directly related to revenue. More the revenue, more output, and which implies more production, more profit, and more revenue means investment has to be done on machinery, purchasing of new land, new instruments for the purpose of production, and that will lead to increase in the investment. So revenue and investment has direct relationship with each other. There is positive relationship. As revenue increases, investment also increases. Another factor which affect your investment is the expectation. Now it is the profit expectation of the entrepreneur which determines the level of investment. Now business invests to earn profit, and therefore if there is expectation of earning more profit in future, then today the investment will increase. Because if there is a demand of the product, and if in future if businessman sees that there will be demand and there is more expectation about the profit, then obviously investment will increase. Another determinant of investment is the cost, and the main factor is the interest rate. So rate of interest can be referred as the cost of borrowing money for financing the investment, and there is inverse relationship between interest rate and investment spending, because if interest rate increases, it means that the opportunity cost of investment also increases. So therefore there is inverse relationship, and if there is interest rate more and profit revenue of the business by investing that money in the business is less, then obviously the investment will be less. So therefore it is negatively related, and therefore you can see the graph that it is downward sloping, and in this graph you can see that we are taking investment on x-axis and the rate of interest on the y-axis, and the investment curve that you can see is the downward sloping, which indicates that there is inverse relationship between the two. Then another determinant of investment which is very, very important is the marginal efficiency of capital. Now what is marginal efficiency of capital? It is nothing but the expected rate of profit or rate of return from investment in certain capital assets. The rate of profit expected from an extra unit of capital asset is known as marginal efficiency of capital. So in simple words, you can say that how efficient the capital is, how efficient your investment is, what will be the return on the investment which you are going to make today. So that is the determinant of investment, and any businessman whose expectation is to earn more profit, so obviously they would like to see what is the efficiency of the capital where they are investing money. Now to estimate the MEC, that is marginal efficiency of capital, the entrepreneur will first take into consideration how much price he has to pay for a particular capital asset. That means what is the level of investment, what is the price of that capital asset which you are going to buy to start your business or to expand your business. So the price he has to pay for the particular capital asset is called the supply price or cost of capital. Because for any investment decision, first of all we should know what is the supply price or what is the cost of the capital, what is the investment that is required to start that business. Second thing he will consider is that how much yield he expects to obtain from investment from that particular capital asset. Like suppose if today anybody invests 50 lakh rupees in the business and he starts his business with 50 lakh, so 50 lakhs becomes the cost of capital. So any businessman would like to know for how many years that capital or that investment is going to give return to this businessman, and what will be the return, how much yield, how much return he is going to get by this investment of 50 lakh rupees. So entrepreneur has to estimate the prospective yield from a capital asset over his whole life period, and prospective yield refers to the net expected return from the capital assets over its lifetime of that investment. Now according to Keynes, if we see, then supply price is equal to discounted prospective yield. So supply price, if mathematically if you see, then it is R1 upon 1 plus I small I plus R2 upon 1 plus I whole square. So SP here is the supply price of the replacement cost. R1, R2, R3 up to Rn is the annual return from the capital asset, and I is the rate of discount, okay, or we can take it as the rate of interest as the rate of discount. So investment will take place only if when net prospective yield of an asset is greater than its supply price. Because see, whatever today we are investing, like I gave you example of, like suppose today we are investing 50 lakh rupees in the business. So 50 lakh rupees is the supply price of that business. So total return or the present value of the total future return that we are going to get out of this 50 lakh rupees should be more than the supply price, that means more than the 50 lakh rupees which we are investing today. Then only it is worth investment, otherwise no. So the investment demand curve shows the volume of investment spending per year at each rate of interest. Okay, so this is the investment curve, you can say, which is negatively related, which is negatively sloped, and it shows that at what level of rate of interest how much investment will take place. So the investment demand curve is a downward sloping, and it shows that there is a negative relationship between the investment curve and the interest rate, and the curve shows that as the rate of interest falls, the level of investment per year rises. Now, if you want to see the shift in this investment curve, then what are the factors that lead to shift in the investment curve? A change in any determinant other than interest rate and MAC causes a shift in the investment demand curve. Because if we are taking on y-axis rate of interest and x-axis investment, so if there is change in rate of interest, then there will be movement along this same investment curve, then shift will not take place. But other than the rate of interest, if there is change in any other factor can be like expansion of the market, or suppose there is increase in the population growth, increase in the level of income of the people, or change in the government policy, whatever factor it is, other than rate of interest, if there is change in those factors, then there will be shift in the investment demand curve. So all these determinants may include like revenue, GDP, okay, government policy, expectation about the future and all, which will lead to shift in the investment curve. When due to change in any other determinant, the investment rises, then it will cause a rightward shift in the investment curve, and leftward shift when the investment falls. Okay, so this is just same as demand curve, like rightward shift when there is increase in demand, or leftward shift when there is decrease in the demand. So that movement and shift takes place in the similar manner. Now, what are the factors that cause shift in the investment demand curve? If we can just recall quickly, Then first is like change in the marginal efficiency of capital due to changes in the expectation about the profit margin or expectation about the demand in the economy. Then expected demand for the products, okay, because if because demand and profit also are directly related. If demand increases, then obviously the profit will increase, because increase in demand will lead to increase in the prices. Increase in price again will lead to increase in the profit of the businessman. Then technology and innovation, user cost of capital, availability of credit, because if there is more availability of credit, okay, if government is having liberal policy, monetary policy, fiscal policy, and if they are providing loan at lower interest rate, or they are providing loan with less of the formalities, less of the paperwork, then also people go for credit. So fiscal policy again is the factor which affects or which lead to shift in the investment curve. The next part of this session is like, what are the different methods for this investment decision making? How do we make investment decision, whether we will go for the investment or we will not go for the investment? So the decision on investment is essentially related to the theory of demand for capital. The capital is demanded because it is productive and yields a return over time. But the return on capital is subject to the cost, that is interest paid on money spent on capital acquisition. So firms, their main objective is the maximization of profit. So therefore firms acquire capital stock that maximizes their profit given the cost. Okay, so the theory of investment deals with how firms decide on the profit maximization level of the capital stock. So theoretically as well as practically, there are different methods of making investment decision. Now we will discuss here two important methods of investment decision making. First is the net present value method, and the second is the method based on marginal efficiency of capital. Now first if we talk about NPV, that is net present value method, then the net present value method is one of the most popular method of taking decision on investment projects. The net present value is defined as the difference between the present value of a future income stream from investment and the cost of investment. So net present value is the NPV is equal to present value of all the returns that we are going to get in future minus the cost of capital. Okay, so here NPV is nothing but the net present value, PV stands for present value, and C stands for the cost of capital. The present value of future income is the value of the future income discounted at the current market rate of interest. The future income is discounted at the market rate of interest under the assumption that prices remain constant and there is neither inflation nor deflation. So that means we are assuming here that prices will remain constant, and this assumption implies that the real value of money remains the constant. Okay, so the need for discounting future income arises because money has a time value. Like suppose for example, if I ask you one thing, that which one will you prefer, 100 rupees today or 100 rupees 5 years back, 5 years ahead or after 5 years? So you will always prefer 100 rupees today. Why? Because money has its time value. Today's 100 rupees will not be same as 100 rupees after 5 years or after 3 years. Even if there is no inflation, there is no deflation, because we always prefer present than future. Okay, so the time value of money implies that an amount of money which is preferably today to the same amount at some future date. Same example, like suppose for example 100 rupees is always preferable today to 100 rupees after 1 year or after 5 years or some other future date. So the reason for this preference is the loss of interest on the deferred receipt of the amount. Because if you invest that money in the bank or if you give loan to somebody, you will earn interest on this 100 rupee. Now for example, again going with the same example, if a person receive rupees 100 today and deposit it in the bank at the rate of interest which is 10%, okay, per year. So his deposit of rupees 100 today will be equal to 110 after 1 year, because rupees 100 plus 10% interest, that means rupees 10, so 100 plus 10, it is 110. And that is why rupees 100 today is preferable to rupees 100 after 1 year, because either there should be 110 after 1 year, and then you can say that then a person may be indifferent between 100 today and 110 after 1 year. So it means that present value of rupees 110 receivable after 1 year hence is rupees 100. So at 10% rate of interest, the present value of an income receivable after 1 year is estimated by discounting formula like PV, present value, is equal to R upon 1 plus I. 1 plus I here is the rate of interest. So equation implies that to get 110 after a year, rupees 100 must be invested today. Now going by this logic, the present value of an amount expected at some future date is the sum of the money that must be invested today at a compound rate of interest to get the same amount at some future date. Okay, so that was the present value method. So that means, in other words, you can say that whatever return we are going to get from the investment, you should know what is the present value of all that return. And if present value is more than the cost of capital, then it is worth investing, otherwise it is not worth investing. The next method is the marginal efficiency of capital method. Now Keynes has suggested an alternative method of investment decision based on like what is called as marginal efficiency of capital. The MEC is also known as internal rate of return, RRR, IRR, and according to Keynes, the marginal efficiency of capital is that rate of discount which makes the present value of the series of annual return given by returns expected from the capital assets during its life just equal to its supply price. Now in simple words, MEC is the rate of discount which makes the discounted present value of the expected income stream equal to the cost of capital. Now for example, suppose cost of an investment project is C and it is expected to yield a return R for 1 year. Then MEC can be found as MEC is equal to R upon 1 plus R, which is equal to C. So here R is the rate of discount that makes the discounted value of return, which is equal to C. So therefore, you know that the value of R represents the marginal efficiency of capital or internal rate of return. The value of R can be obtained by rearranging the term, that is small r is equal to R upon C minus 1. Now for example, suppose an investment project cost 100 million and is expected to yield 125 million at the end of 1 year. So by substituting these values, you can see and you can find out the value of R, which is 25%. So if we just see the decision rule, then once MEC or IRR is estimated, the investment decision can be taken by comparing MEC with the market rate of interest. And what are the general investment rule? That if MEC is greater than I, greater than the rate of interest, then investment project should be acceptable, because if your return is more than the interest rate in the market, then it is acceptable and people will go for investment. And if MEC is equal to I, then the project is acceptable only on non-profit consideration. And if MEC is less than I, then the project is not at all acceptable, because if your return is less than the interest which you can earn from the bank investment, then you will not take risk of investing money into the business. So these are the basic investment decision rule. So thank you so much, and I hope you are clear with the concept of investment decision making. And thank you. We will meet again with the next topic. Thank you.